In today's show, we're going to be looking at whether the Bank of Japan is ever going to hike after comments overnight. And we've seen that many analysts are predicting that the ECB will now cut in June rather than September of next year. What does this mean for the euro? And our trading takeout today is to always focus on rates. And I'm going to get into that when we're referring to how FX moves. So overnight, there's been a report that's come out with regards to Governor Ueda's recent comments about the BOJ, Bank of Japan, having enough data to suggest that they could exit negative rates by the end of the year. Now, it is a real mess, this communication, because what he actually meant was he was saying that it's a general comment. You know, he wasn't saying that that's a policy that they're gonna actually follow, but the market jumped on it, and the market absolutely sold the hell out of the yen earlier this week. But then it got bid up because they denied the comments, and you can see that buying up right here. So you can see, the market get absolutely obliterated again here. So this is where it occurred overnight, and this is the buying up to break the high from earlier this week. Now, the Bank of Japan is in quite an interesting place because their inflation's actually ticked up to about 3%. So, people are now, or started at least, to bet on a rate hike occurring in January. Traders did anyway. Economists bet on it for April. The interesting thing to me is that they're still buying unlimited bonds between the 5-year and 10-year. So what the Bank of Japan is effectively doing is they're doing something called yield curve control. So they're controlling the belly of the yield curve, and they're pinning it to a certain level. I think it's 25 or maybe 50 basis points now. I can't recall. But they're still doing massive QE, basically, just a different type to what the Bank of England, the Fed, ECB, etc., have been doing. They've all had their own different nuances with QE, but the Bank of Japan is doing something very unconventional because they've done all of these, more traditional types of QE. It's getting really funny and kind of alchemistic now, but they've been doing this traditional type of QE for 20 odd years now, since 1998. And if you even just take that time frame that they've been doing it for so long, for me, taking a probabilistic outlook on it, it doesn't look like they're ever going to be able to hike, because the extent of unwinding, the extent of unwinding and the extent of moving relatively from the long entrenched type of policy that they've had now for so long, it would just change so much. It would be a drastic change. And their demographics structurally as well don't suffice to cause sort of like a wind to the upside in inflation. There's no likely spiral from the demographics that Japan has to boost inflation. So they're in a real rock and a hard place. Probably one of the most difficult decisions would be whether to ever raise rates in Japan, because there's just so many confounding factors that just wouldn't let it make sense. The good thing, though, is that there's a trade in here, and that's going to be today's trading takeout, of course, how rates affect FX, and we're going to get onto that afterwards. So after speaking about the Bank of Japan, we are looking at an equally dovish, it seems, central bank in the ECB. The Guindos has come out this morning. He's an ECB governing council member, and he said that rates at this level for some time is enough to tame CPI. Now, what we're looking at here with regards to the euro is really just a relative sort of value trade on the yield differentials. So we're looking at the run up here through 2022 when they were getting hawkish, and then we've seen a sudden change in the last month or two where we've hit the long-term trend line, the 15-year trend line, and now all of the comments coming out saying that they don't think the rate hikes are going to go on for as long as first thought. And the way that I would look at this is probably similar to how Citibank Citibank are interpreting it. So Citibank are thinking that the ECB are going to hike in, I believe it's June rather than September next year. So they've brought hikes forward, cuts forward by 3 months. And this basically is showing a change in velocity and a change in volatility of interest rate pricing, which is thoroughly negative for the euro, especially when we consider that the Fed are likely to hike in November. So as we reach that pricing in moment, you've got to pay attention to the differentials that are going on. I'm going to get onto this more in the trading takeout, but we've got to pay attention to the differentials that are occurring. Eurozone data is weakening, and I think that has a massive effect here on this trend line, which has caused less hawkishness. Basically, the data started weakening right about here. Okay, which started to say, okay, there could be a recessionary sort of cloud on the horizon. Maybe we need to start thinking that the ECB can't really hike as much anymore, and they might have to think about pricing in a cut next year. So that's really the trade. I don't really see the euro being able to strengthen much, especially versus the dollar. And there's an interesting trade as well in euro JPY, because if we take the context of, the Bank of Japan being very, very steadfast in their, long-term unconventional monetary policy, even though inflation's at about 3%, they don't necessarily want to hike, which is great. But the ECB are now pricing in cuts. So perhaps what we can look at is the certainty of one number staying fixed. Let's say, the certainty of Bank of Japan represents 1. Okay. We know that they're going to stay at their interest rate path. So bond yields aren't going to change that much. But the ECB, they've got a certainty currently of 5, but that's changing to 4. So the difference is now only 3, whereas before it was 4. That means that the currency value is decreasing a little bit. So this is the way that we have to look at it. And yeah, I'm going to explain it fully in the trade and takeout, but that would be my perspective, is to look at euro yen as well for any kind of euro downside off the back of dovish comments from the ECB. So I hope I've given you a good context for interest rates and rates in general. Rates are basically bond yields, okay, from those 2 examples with regards to the Bank of Japan and the ECB. I want to get a little bit more specific now in terms of what I actually mean. So we've got to think of how currencies actually move. So currencies are backed predominantly by interest rates. Okay, if you've got a higher interest rate, you're going to be buying that currency. If you've got a lower interest rate, you're probably going to be selling that currency. So if we take the example of Japan and pretty much anywhere else in the world over the last 20 years, there's been a fantastic trade where you can sell the yen, or you can loan in yen, and then you can buy another currency and you can create the interest rate differential. And this is something that investors use quite a lot. It's called a carry trade. And you're basically just making use of something known as uncovered interest parity. So it's when interest rates are diverging and you're expecting one interest rate to increase relative to the other one. And this is really the basis for all currency movements. And I think making sure that this is at the forefront of anything that you do in FX, not necessarily in the short term, but maybe the midterm, is absolutely essential.